We saved $152,000 in 3 years on an average combined income of 200K during that period. And in this video, we're gonna talk about our strategy and how we built that.
And here's the part that surprises most of the people. It was 15% deposit and not 20% with zero lender mortgage insurance.
So this video is two things: the three accounts, the saving setup, the sprint in the end, and one shortcut that we missed that could have worth $10,000 to us.
The mistakes that we did is coming soon in a couple of minutes. And if you're saving right now, it is one of the biggest mistake you might get wrong. Also, a quick disclaimer. We are not financial advisors. This is our personal journey and what worked for us. And if you're saving for your first home, you should talk to a financial advisor or a broker for the right approach.
First thing to clear up that we did not save 20% deposit, we saved 15%, and still we didn't pay any lender's mortgage insurance or LMI.
That's the whole trick for this video. So let's talk about what LMI even is. If you borrow more than 80% from the lender for property's value, you have to pay a once-off premium as lender's mortgage insurance, which runs for about thousands of dollars and it sits on top of your mortgage.
One thing that no one tells you is LMI does not protect you, it protects the bank. It's the insurance premium you pay for, and if you default, the insurer pays the bank, but they can still come after you.
So the entire game for the first home buyers is to get above that 80% without paying the premium. There are three ways to do it. We did one of them, and we'll be honest about the other two that we didn't.
Route 1, the one we actually used. Some lenders run an offer that don't charge LMI for going above 80%. We went with UBank, which had a standing policy at that point that if you are borrowing for 85%, there is no LMI, there was no professional list, no government scheme. We were just comfortably inside it because we had 15% deposit with us.
Worth saying clearly though, we're not asking you to go with UBank here. Lenders constantly change these rates and they constantly move the needles. Some offer 85%, some offer 90%, no LMI. So it's a moving target and they do this for a living. So when you're buying, make sure you check that for yourself first and not at the price that we bought for.
One honest caveat: a no LMI loan sometimes have a higher interest rate. The comparison isn't against an 80% loan, but against borrowing the same amount and paying the premium. On that test, it was better for us to have a 15% deposit, but do that test yourself.
Route 2, first home guarantee. 5% deposit, 0 LMI. Government guarantees 15% of deposit with no LMI here. This wasn't available for us. It was introduced recently in October 2025. It is one of the strongest option available right now for first home buyers.
Route 3 is professional LMI waivers. If you work in certain fields, the lenders will waive LMI for up to 90 to sometimes 95%. And these just not include doctors and dentists that most people think. For some lenders, they can include lawyers, vets, nurses, banking, and finance staff.
So, if you're in any of these professions, do ask the broker or the lender before you assume you need a full 20%. This one is pure based of eligibility. You're either eligible or not. Plenty of times you are eligible, but it's just you're not aware of your professional list.
There are three routes to avoid the LMI. The question that left is, how much deposit do you actually need? Because the deposit isn't just one number, it's a pool.
Conveyancing, building and pest report, loan establishment fee, stamp duty, all of these come out of the same pool before you even get house key. And stamp duty concessions also vary state to state. So make sure you do check your state revenue offices for the stamp duty concession.
Then there's borrowing power. The bigger deposit means smaller loan, smaller repayment, and the bank is likely to say yes.
And a buffer nobody talks about. The month you move in, the hot water dies. So we did wanted to have a certain buffer for ourselves and not have zero amount in our accounts.
We should be honest about the scale though. In a recent report, it was found the time to save for a deposit went from 9 years in 2015 to around 11 years in 2025.
We're not going to pretend that we cracked the code. Honestly, we both had stable jobs. So we are here to give you a system which worked for us and you can scale it as per your needs and your understanding. Right. So now time to talk about the expensive mistake, the first home super scheme.
The idea is simple. You make voluntary contributions to your super and later withdraw them to purchase your first home. Right now, you can deposit $15,000 per year, total of $50,000 for one person, and for two eligible person, that could go up to $100,000 combined.
The reason it works is because of your tax. When you salary sacrifice, it is taxed at 15% rather than your marginalized tax rate.
So, if you're earning $90,000 per year, your marginal tax rate is around 30%. If you deposit $15,000 into your super, you pay 15% tax on the way in instead of 30% tax that you could have paid if sitting outside.
Roughly, this depends on your income. It can be $2,000 each per person and about $12,000 over the span of your saving for the deposit. Make sure you do run through your numbers with ATO's FHSS calculator.
And here's where most videos stop because there are three things which are important about FHSS which you should know. Number one, you don't get 100% of your money back because it's taxed 15%. So you get 85% of your money back plus any earnings that you have gotten while it was sitting inside your super. Number two, the $15,000 annual limit sits inside the concessional cap, which in 2025-2026 is around $32,000. So if you're on a higher income, do your subtractions because if you do go over $32,500, you pay the penalty tax. Number three is the one that burns most people. You have to apply to ATO for determination through MyGov before you sign the contract, not after.
So, our mistake when we did start saving, we were not sure about this scheme, and most of our deposit saving was sitting in a high interest saving account. So, a lesson that you all can take away from this is if you have started saving for your home deposit, this is going to be the biggest return for yourself. So, do check FHSS scheme.
Okay, the system. The three accounts that run automatically. The point of it, it runs without us making decisions. Account one, actually two accounts. Our individual salary account where our paycheck lands and then we distribute our paychecks. The account two is for bills, rents, which are predictable costs, and we deposit some amount into that. The account three is entirely for our home deposit. Every money in that account is for our home deposit. One mistake that we initially did was we overestimated how much we could save. So we constantly had to pull money out of our home deposit account to pay for our expenses.
Okay, so while that cash is sitting in your account, it should also work for you. The lazy bank methods give you 1% in your savings account. So make sure that you double check that and deposit that into a high savings rate interest account where you can get about 5 to 5 to 5.5% of interest rate. The other things to check out is some of the banks do make you jump through hoops for saving this much amount every month. So keep that in a check for every 6 months and do compare it every once in a while. Banks sometimes quietly drop the interest rate as well. So loyalty is not really rewarded here. Again, make sure you keep checking every few months.
The last thing is the mindset shift in the end. When you're within 6 months to 12 months, the target is visible. We called it the final sprint. For us, we cut down a lot of our costs, like eating out, some major expenses, things we don't need, we didn't buy. Honestly, this wasn't fun. We couldn't have sustained it for 3 years, but because it was a short period and the end was in sight, we were able to achieve our target deposit 2 months earlier than we were initially planning.
If you want to map out your own timeline, we have a free tool called CASA, which would help you to determine your target dates and your target amount. You just have to input the income and a few more parameters. The link is in the description below. Also, if you've went through the FHSS scheme pretty recently, tell us about your experience in the comments. Subscribe to our channel for more such Australian finance journeys, and we'll see you in the next one. See ya.